Part 1. Investing for Beginners, the system that actually works. Written and published by Mindset Masters Audiobooks. To the beginner standing at the edge of the financial world, investing can feel mysterious, overwhelming, even intimidating. You hear terms like stocks, bonds, index funds, portfolios, compounding, dividends, inflation, and risk. You hear people say just invest, but no one explains what that actually means. You hear about people losing money, and you hear about people becoming wealthy, and you wonder which one you would become if you stepped forward. This book exists for one purpose: to remove the fear, the confusion, and the complexity, and replace them with clarity, confidence, and a simple system that anyone, truly anyone, can use to build financial stability and long-term wealth. This part sets the foundation. It introduces you to the mindset, the principles, and the purpose of investing. Before we discuss tools, strategies, or techniques, you must understand the landscape. The strongest investors are not the ones who know the most technical terms. They are the ones who understand the big picture and apply simple, consistent actions over time. This is the foundation that wealthy people teach their children, but beginners are rarely given access to it in a clear, honest way. Today, that changes. Why investing matters more now than ever. Investing is not a hobby reserved for experts. It is not something only smart people do. It is not something you do after you make a lot of money. In today's world, investing is a necessity, because relying on savings alone is simply not enough. Here's the truth that most beginners never learn early enough. Money loses value every year. Inflation increases prices. $1 today buys less next year. Saving alone cannot keep up. But investing allows your money to grow, to beat inflation, to multiply, and to work for you even while you sleep. The wealthy understand this. They don't work only for money, they make money work for them. This is the difference between people who remain stuck financially and people who create freedom for themselves and their families. The biggest myth: investing is complicated. If you are new to investing, you may have heard that it's risky or difficult. Maybe someone told you it's like gambling. Maybe you worry that you'll pick the wrong investment and lose everything. These fears keep millions of people out of investing, but the truth is, the system that actually works for beginners is simple, safe, steady, and proven over decades. Successful beginner investing is not about picking lucky stocks or timing the market. It's about small, consistent contributions, simple investment choices, long-term growth, patience, understanding the basics. You don't need to be brilliant. You don't need to be wealthy. You don't need to study charts or predict anything. You only need a clear system, and the willingness to follow it. The true purpose of investing: freedom, not stress. Most people think investing is about getting rich. Wealth is a benefit, yes, but the deeper purpose is freedom. Freedom from worrying about every unexpected expense. Freedom to choose jobs, opportunities, and lifestyles. Freedom to retire earlier or build passive income. Freedom to create safety for your family. Freedom to say yes to experiences and no to financial pressure. When beginners understand this purpose, investing becomes far less intimidating. It becomes exciting, because it becomes a tool you control, rather than something you fear. What makes this system different? There are thousands of investing strategies. Many are complicated. Many require advanced knowledge. Many are designed for short-term profit chasing, which often leads beginners to frustration and loss. But wealthy people, truly wealthy people, rely on a handful of timeless principles. They don't need complicated systems because simple systems are powerful when done consistently. The system you are about to learn works because it is designed for complete beginners. It does not rely on guessing or luck. It prioritizes safety and long-term growth. It uses the natural power of compounding. It requires very little time to maintain. It has worked across decades, economies, and countries. This book will break down the system step by step in later parts. But first, let's build your foundation, your mindset, your clarity, and your long-term vision. The foundation of a beginner investor's mindset. Before you can invest effectively, you need the right mindset. Not the mindset of an expert, just the mindset of someone willing to learn and take action slowly and consistently. Here are the 5 core mindset principles you must understand in Part 1. 1. You don't need to know everything, just the right things. Many beginners think they need to understand advanced financial terms before they can invest. They think they must become experts. This belief stops them from starting. But the truth is this. You only need to understand the basics that actually matter. This book teaches those basics, slowly, clearly, and practically. 2. You don't need a lot of money to begin. Most people wait until they have more money before they start investing. But beginners who start early with small amounts often end up wealthier than people who start late with larger amounts. Because time matters more than money. $20 consistently invested can have more impact than $200 invested randomly. Your future is built from tiny steps repeated over years, not from giant leaps performed once in a while. 3. You are not competing with anyone. Investing is not a race. You are not trying to beat professional investors or outperform people online. You are building your own system, at your own pace, for your own life. Success comes from staying consistent with a simple strategy, not trying to get ahead of everyone else. 4. You are allowed to start slowly. Many beginners feel pressure to do it right immediately. They feel like one mistake will destroy everything. This fear prevents action. You don't need to be perfect. You don't need to invest aggressively. You don't need to understand everything at once. You can begin small. You can adjust later. You can learn as you go. Everything in this book is designed to allow you to build confidence step by step. 5. Investing is a long-term game, not a one-time event. The reason most beginners fail is simple. They quit too early. They expect fast results. They invest for a few months, see small returns, and think it's not working. But investing is not supposed to reward you immediately. It rewards those who give it time. You are building a system that will benefit your future self, the person you will be in 5 years, 10 years, and beyond. You are planting seeds today so your future can grow. This book shows you exactly how to plant wisely and consistently. Why beginners fail, and why you won't. Most beginners fail not because investing is hard, but because they approach it incorrectly. They make these common mistakes. Investing without understanding the basics. Trying to pick winning stocks. Listening to hype and social media predictions. Switching strategies constantly. Investing emotionally instead of logically. Quitting after a small loss. Thinking short-term instead of long-term. You won't make these mistakes because this book gives you a system that prevents them. When you understand why the system works, you become a confident, disciplined investor, not someone who reacts to fear or excitement. What you will learn in this book. After this introduction, each part will walk you through a pillar of the system that works for beginners. These pillars build on each other, forming a simple but powerful structure. How to prepare before you invest. How to remove beginner fears and confusion. How compounding works and how it changes everything. How to choose safe, beginner-friendly investments. How to build your first simple portfolio. How to invest even if you don't earn much. How to avoid the traps that keep beginners stuck. How to stay consistent over years. How to grow wealth quietly, safely, and steadily. By the end of this audiobook, you will not only understand investing, you will know exactly how to apply it. What makes a system actually work? A system works when it is simple enough for beginners, easy to follow, safe, low maintenance, proven over decades, consistent, aligned with long-term growth. This book is not about shortcuts, tricks, or hype. It is about building wealth the same way millions of ordinary people have done, little by little, month after month, year after year. This is how people with average incomes build stability, security, and freedom. You are ready, even if you don't think you are. Beginners often believe they're not ready to invest because they don't know enough. They don't earn enough. They think it's too risky. They think they'll mess up. They feel overwhelmed. But every wealthy investor was once a beginner who felt the same way. Experience comes from starting. Confidence comes from taking the first step. Clarity comes from learning through simple action. This book gives you everything you need to begin, safely, wisely, and confidently. Part 2. How to build the investor mindset before you ever invest a shilling. Before you touch a single investment, you must build the mindset that makes investing work. Most beginners jump straight into choosing stocks, crypto, or real estate, then crash because they skip the foundation. This part builds that foundation. Start by seeing yourself as an investor. Wealth begins with identity. If you see yourself as a beginner who is trying to learn, you will hesitate. If you see yourself as an investor, you start behaving like one. An investor doesn't act emotionally. An investor doesn't chase hype. An investor doesn't panic when the market shakes. The investor identity forces you to think long-term and build habits that support wealth. Say it to yourself every day. I am an investor. I make decisions based on information, not impulse. Why most people never build wealth. Most people stay broke for 3 reasons. They want results faster than discipline can deliver. They want big returns immediately, so they gamble instead of invest. They hate patience. They treat investing like a sprint, not a marathon. They believe wealth is luck, not strategy. They think rich people got lucky, ignoring the years of consistent behavior. You're already different, because you're choosing to learn a system that works. The one skill every beginner must master. Before picking an investment, master this. The ability to delay gratification. Investing is the process of rewarding your future self more than your present self. When you delay gratification, you spend less. You save more. You stay consistent. You stop chasing quick wins. You respect the long-term game. This mindset alone can separate you from 95% of beginners. Separate your investor mindset from your consumer mindset. Your consumer side wants pleasure. Your investor side wants progress. Your consumer side wants the new phone today. Your investor side wants ownership, assets that grow over time. Ask yourself daily, am I behaving like a consumer or an investor? When you choose the investor mindset more often, wealth follows. The rule of calm, no emotion-based decisions. Every beginner must understand the biggest threat to wealth, emotions. Fear makes you sell too early. Greed makes you buy too high. Impatience makes you chase bad opportunities. So here is the rule that will save you over and over. Never invest when you're excited. Never sell when you're scared. If your emotions are loud, pause. Markets reward logic, not feelings. Start thinking in decades, not days. Beginners obsess over. Is the price rising today? Should I buy now? Is it too late to invest? The wealthy think differently. They ask, where will this asset be in 10 years? Is this investment part of my plan? Does this align with my risk level? Time is the most powerful force in investing. When you stretch your timeline, your stress shrinks and your potential multiplies. Why long-term thinking works, and always will. There is one truth all successful investors rely on. Markets reward patience. Historically, every major market goes through dips, goes through corrections, goes through crises, but always trends upward long-term. You only lose when you quit. You only fail when you stop. You only suffer when you react emotionally instead of strategically. This is why long-term thinking is your superpower. Focus first on what you can control. You cannot control interest rates, inflation, market crashes, global events, investor sentiment. But you can control your contributions, your strategy, your discipline, your risk tolerance, your education, your patience. Investing becomes simple when you stop worrying about what you cannot influence. Put all your energy into what you control. That is where wealth is built. The beginner's formula for confidence. Most people feel overwhelmed when they start investing. That's normal. The way you build confidence is simple. 1. Learn a principle. 2. Apply it. 3. See a small win. 4. Repeat. It doesn't matter how small the win is. Your first consistent savings deposit counts. Your first $10 of growth counts. Your first month of sticking to your plan counts. Confidence comes from action, not information. Building your investor habits. Here are habits that set you up for real success. 1. Automatic saving. Remove emotion and automate your contributions. 2. Weekly learning. Spend at least 20 minutes per week learning something new about investing. 3. Monthly review. Check your investments without overreacting. 4. Ignore noise. The news exaggerates everything. Focus on your plan, not headlines. 5. Consistency over perfection. Missing a month won't break you. Stopping will. Shift from how fast to how certain. Most beginners ask, how fast can I get rich? The right question is, how certain can I make my wealth building process? Fast results are unstable. Certain systems are unstoppable. The method you're learning here focuses on certainty, small steps that compound into life-changing results. The mindset that guarantees wealth. If you embrace this simple principle, wealth becomes almost inevitable. Invest automatically, consistently, and for the long term. No matter how you feel. No matter what the market does. No matter what anyone else is doing. Success stops being emotional. It becomes a habit. You are now ready for the next level. With this mindset, you're no longer just a beginner. You're an investor who thinks long-term, stays calm, respects the process, and chooses habits over hype. You're ready to learn the practical system that actually works, step by step. Part 3. The only investing strategy beginners should use. Most beginners fail because they jump between different strategies. Crypto today, stocks tomorrow, real estate next month. They move with trends instead of principles. This part shows you one strategy that works across time, across markets, and across income levels. It's simple, predictable, and nearly impossible to mess up when done correctly. This is the strategy wealthy people quietly rely on. Why you need a simple, boring, predictable strategy. Most beginners think investing must be complicated. It doesn't. Complex strategies look impressive but fail easily. Simple strategies look boring but win consistently. Your goal is not to find a magic investment. Your goal is to build a system. And the simplest system, the one recommended by billionaires, CEOs, and top financial experts, is this. Low-cost, long-term, automatic investing. Through index funds or broad market ETFs. It's the strategy that beats 90% of professional investors over the long term. Let's break it down step by step. Step 1. Understand what you're actually buying. When you invest in a broad index fund, like one that tracks the top companies in a country, you are not buying one company. You are buying hundreds or thousands of companies at once. This means, if one company fails, you're safe. If a few companies slow down, others carry the market. You don't have to guess winners. You don't have to time the market. You grow as the entire economy grows. This is the foundation of stress-free investing. Step 2. Stop trying to beat the market. Beginners try to beat the market. Professionals know how hard that is. You don't win by being a genius stock picker. You win by owning the entire market. This removes guessing, gambling, sudden losses, stress, and emotional decisions. And the best part, you don't need to watch charts or learn complicated analysis. Your investment grows automatically as markets grow. Step 3. Set up automatic monthly investing. This is the engine that makes the system work. You choose a fixed amount and invest it automatically every month, no matter what the market is doing. This strategy is called dollar-cost averaging. It means you buy less when the market is high, buy more when the market is low, and build wealth steadily without thinking. Automating contributions protects you from emotions and ensures you never forget to invest. Step 4. Focus on long-term compounding. The wealthy rely on one thing above everything else. Compounding. Compounding makes your money grow on top of your previous growth. It rewards consistency, patience, discipline. Even small contributions grow massively over time with this system. You don't need big money. You need big discipline. Step 5. Keep your fees low. Fees matter. Expensive investments drain your returns quietly. Low-cost index funds let you keep most of your growth. Always choose low-cost, diversified, long-term funds. This one choice alone can increase your lifetime wealth dramatically. Step 6. Ignore daily market movements. Daily price changes don't matter. Your focus is monthly contributions, long-term growth, steady compounding. Wealth comes from time in the market, not timing the market. When the market rises, stay invested. When the market drops, stay invested. When the market crashes, Buy more automatically. This is how ordinary people build extraordinary wealth. Step 7. Reduce risk by staying diversified. Diversification protects you from unnecessary losses. You don't have to guess which industry will win. You own all major industries automatically: tech, finance, energy, healthcare, retail, and more. Diversification smooths volatility and creates stable long-term growth. Step 8. Don't change your strategy because of noise. Markets will always have crashes, recessions, corrections, bad news, hype, excitement, fear. Stay with your strategy regardless of panic or euphoria. Every wealthy investor will tell you the same thing. The people who panic lose. The people who stay consistent win. Step 9. Review annually, not daily. Reviewing every day creates anxiety. Reviewing annually creates clarity. Check your portfolio once or twice a year to make sure you're on track. Your contributions are consistent. Your risk level is still right for you. Small adjustments are fine, but don't rebuild your strategy every year. Step 10. Understand that this strategy works everywhere. This system works whether you're in Africa, in Europe, in Asia, or anywhere else. It works regardless of income level, education, age, profession, because it's built on universal principles. Diversification, low fees, long-term growth, automatic investing, and compounding. This is why it's the best starting system for beginners. Step 11. Why this system works for beginners. This method is simple, safe, scalable, stress-free, proven, backed by decades of data, used by wealthy people worldwide. You don't need advanced knowledge, big money, charts, technical skills, constant monitoring. You only need consistency, patience, a long-term mindset. This is the system that actually works. You're ready to build the core of your investment plan. Now that you understand the strategy, the next part will guide you into how much to invest, where to start, how to structure your portfolio, and how to adapt based on your risk level. Part 4. How much you should invest, the formula that never fails. Most beginners ask one question: how much should I invest every month? The truth is simple. There is no perfect number. But there is a perfect system that adapts to your income, your goals, and your lifestyle. This part gives you the formula wealthy people use to decide how much to invest, how fast they want their money to grow, and how to stay consistent even when income changes. You'll learn how to design an investment amount that fits your life, not someone else's. Let's break it down. The wealth ratio rule. Wealthy people don't invest random amounts. They follow a ratio, not a number. The golden rule is 20% of your income goes into investments. But this rule is flexible depending on your situation. Beginner level, 5 to 10%. Growing level, 10 to 20%. Ambitious level, 20 to 30%. Aggressive wealth building, 30 to 50%, only if financially stable. The important part is consistency, not size. A small amount invested every month beats a big amount invested once in a while. Why a percentage works better than a fixed number. Let's say you choose to invest 20% of your income. If your income drops, your investment drops proportionally, no stress. If your income rises, your investment rises naturally, no thinking required. If you get bonuses, commissions, or freelance income, everything scales smoothly. Wealthy people automate this ratio so their money grows without relying on willpower. The time-money equation. There are only 3 ways to build wealth. Invest a lot of money for a short time. Invest a small amount for a long time. Invest a moderate amount consistently for a reasonable time. Beginners usually fall into option number 2 or number 3. Both work brilliantly with compounding. The earlier you start, the less money you need. The later you start, the more money you must invest. Time multiplies money. Your number is based on your goal, not pressure. Instead of asking how much should I invest, ask this instead. What do I want my investments to do for me? Different goals need different investment amounts. Build an emergency buffer, small monthly investments. Retire early, moderate, consistent investments. Become wealthy, disciplined, long-term contributions. Achieve financial independence, high contribution ratios. Your goal determines your plan. The 50-30-20 money flow. One of the simplest systems for beginners is 50% needs, 30% wants, 20% investing and savings. But wealthy people upgrade it to 50% needs, 20% wants, 30% investing. This is how ordinary incomes transform into extraordinary wealth. You can adjust the numbers based on your situation, but the core idea remains. Prioritize investing the moment your income arrives. Make it automatic. Once you choose a monthly target. Set automatic transfers. Auto-invest into your chosen fund or platform. Let the system operate without emotion. Why this works? You don't skip months. You don't get influenced by market noise. You don't rely on motivation. Your future becomes predictable. Automation makes wealth inevitable. If you can't start big, start small, but start. Investing is a habit before it's a number. Even if you can only invest a little right now. $5, $10, $20. That is enough to begin. Small investments build the foundation. Large investments come later. Wealth is built by rhythm, not perfection. Increase your investment every year. This is one of the most powerful techniques. Once per year, increase your monthly investing amount by 5% or 10% or every time your income grows. This creates exponential wealth because your income rises over time. Your investments rise with it. Your compounding rises automatically. This is how people become wealthy while living normal lives. Your monthly amount doesn't matter as much as your commitment. Someone who invests $30 every month for 20 years will outperform someone who invests $300 only when they feel like it. The market rewards discipline, not perfection, not luck. Stick to your number and your future becomes unstoppable. The right amount is enough to stretch you, but not enough to stress you. If it hurts too much, you'll quit. If it's too easy, you won't grow. Find the balance that pushes you forward without overwhelming you. This balance creates consistency, and consistency creates wealth. You now have your monthly investment strategy. In the next part, we'll build your beginner-friendly portfolio blueprint, showing exactly what types of investments to include, how to balance risk, and how to make your portfolio grow automatically. Part 5. Building your beginner portfolio, the simple blueprint that works every time. Every beginner eventually reaches the same question. Where exactly do I put my money? You've learned the mindset. You've learned the system. You've learned the habits. Now it's time to build your portfolio, the actual structure that holds and grows your wealth. This part gives you the beginner-friendly portfolio wealthy people recommend to their own children, nieces, nephews, and anyone starting with low experience. It's simple. It's safe. It works in every economy. And it requires almost no maintenance. This isn't about picking the hottest stock, predicting trends, or guessing the future. This is about building a portfolio designed to grow quietly, steadily, confidently, without stress. Let's build the blueprint. The portfolio that works for beginners. You don't need 20 different investments. You don't need complicated charts, advanced trading tools, or expensive courses. You only need 3 core asset types. Stocks, via index funds or ETFs. Bonds, via bond funds or ETFs. Cash reserves, for stability and opportunity. These 3 create the most stable foundation for a beginner investor. Everything else, cryptocurrency, private equity, real estate deals, comes later, once the foundation is strong and automated. You're building wealth the right way. Slow, smooth, steady, and predictable. Why index funds are the beginner's best friend. Most beginners lose money trying to pick individual stocks, trade frequently, time the market, chase hype. Meanwhile, wealthy investors quietly grow richer by using simple index funds. Index funds are baskets of hundreds or even thousands of companies. They give you instant diversification, low fees, strong long-term performance, very low risk compared to buying single stocks. You get exposure to businesses like Apple, Amazon, Microsoft, Tesla, Google, without needing to buy them individually. For beginners, this is the smartest way to grow money consistently. Your simple 3-part portfolio. Here is the blueprint that works anywhere in the world. 1. 70% broad market index funds. This is the engine of your wealth. Examples, depending on your country and platform. S&P 500 Index Fund, Total Market Index Fund, Global Stock Market Fund, Nasdaq Index Fund. This captures long-term economic growth. When companies innovate, grow, expand, and profit, you profit too. 2. 20% bonds or bond index funds. Bonds stabilize your portfolio. Here's why you need them. They reduce volatility. They protect against downturns. They provide steady interest income. They keep your portfolio balanced. Think of bonds as the shock absorbers of your investment strategy. They don't grow fast, but they keep your portfolio calm. 3. 10% cash reserves. Cash is not an investment. It is protection and opportunity. Cash helps you handle emergencies. Avoid selling investments when markets drop. Buy more investments at a discount. Feel secure and confident. Wealthy people always keep some cash available. It keeps their emotions steady and their decisions intelligent. Why this portfolio works? Because it follows the 3 rules of long-term success. Rule 1. Diversification. Your money is spread across industries, countries, companies, time. No single event can destroy your portfolio. Rule 2. Low fees. Index funds are cheap. Low fees save you thousands over your lifetime. Rule 3. Automatic growth. The market grows over time. Your portfolio grows with it. You don't have to guess. You don't have to predict. You just have to stay invested. Adjusting the blueprint for your age. A simple rule. Younger investors more stocks. Older investors more bonds. Example. Age 20 to 35. 80 to 90% stocks. 10 to 20% bonds. 10% cash. Age 35 to 50. 60 to 80% stocks. 20 to 40% bonds. 10% cash. Age 50 to 65. 40 to 60% stocks. 40 to 60% bonds. 10% cash. You adapt the mix as your life evolves. Why most beginners fail, and how you won't. Beginners fail because they panic during market dips. Try to pick winning stocks. Follow the crowd. Invest inconsistently. Don't have a clear portfolio. React emotionally instead of logically. But you are building a system, a structure, a plan. When you have a plan, emotions don't control you. Your portfolio grows because it's designed to grow. What you should not add yet. At this stage, avoid day trading, forex, penny stocks, options trading, NFTs, complicated hedge fund strategies, speculative investments, friends' business ideas disguised as investments. These are distractions for beginners. You're learning the fundamentals of wealth. You're building a foundation that makes you wealthy for the rest of your life. Once the foundation is strong, you can explore advanced strategies. But not now. Right now, simplicity is power. Your portfolio should be boring. That's why it works. You don't want excitement. You want results. Excitement creates losses. Simplicity creates wealth. If your portfolio looks simple, calm, and predictable, you're doing it right. Wealthy people do not get rich from excitement. They get rich from discipline and structure. Automation turns this portfolio into a wealth machine. Here's the secret. Once you choose your portfolio, automate everything. Automatic monthly deposits. Automatic purchases. Automatic rebalancing, if your platform offers it. You are designing a portfolio that grows quietly while you live your life. This is how beginners become long-term winners. Your beginner portfolio is now complete. You now have a simple, powerful, beginner-friendly portfolio that protects you, grows your money, requires almost no maintenance, reduces stress, works in every economy. Part 6, Understanding Risk, How Beginners Stay Safe While Their Money Grows. Most people are not destroyed by bad investments. They are destroyed by bad decisions. They panic. They rush. They follow hype. They listen to noise. They react emotionally. And the market punishes emotional decisions every single time. This part teaches you how beginners protect themselves from risk, not through complicated charts or predictions, but through systems, clarity, and psychological discipline. We are going to break down what risk really means, the types of risks beginners must know, how to manage risk without fear, how wealthy people stay calm when markets fall, the mindset that keeps your investments safe for life. Let's begin. What risk actually means. Most beginners think risk means losing money. But in investing, risk has a better definition. Risk is the possibility of your investment not performing the way you expect, in the time you expect. That means markets fall. Companies slow down. Global events disrupt the economy. Your portfolio moves up and down. This is normal. Volatility is not danger. Uncertainty is not danger. Temporarily losing value is not danger. The true danger is making emotional decisions during temporary movements. Short-term risk versus long-term safety. Here is a truth beginners must accept. Investing looks risky in the short term but becomes safer the longer you stay invested. Why? Because crashes are temporary. Recoveries are permanent. Compounding strengthens over time. Long-term market growth smoothens volatility. If you look at any one-year window in the stock market, it looks unpredictable. If you look at any 20-year window, it looks unstoppable. Time reduces risk. Patience multiplies wealth. The 4 types of risk every beginner must understand. There are 4 main risks. 1. Market risk. The market goes up and down. The solution: stay invested, diversify, avoid panic. 2. Inflation risk. Your money loses value if it doesn't grow. The solution: own assets that rise faster than inflation, like index funds. 3. Emotional risk. Reacting to fear, hype, or greed. The solution: have a long-term plan and automate your investments. 4. Concentration risk. Putting too much money into one stock, one idea, one friend's business, or one crypto coin. The solution: diversify across many companies through index funds. Most beginners only fear market risk, but emotional risk is the real enemy. Why you should expect your portfolio to drop. Yes, expect it. Your portfolio will fall many times. 5% drops happen often. 10% drops happen every year or two. 20% plus drops happen every few years. Big crashes happen several times in your lifetime. Every successful investor goes through them. The difference is simple. Beginners see dips as danger. Wealth builders see dips as opportunity. When prices go down, wealthy investors buy more, because everything is on sale. How to stay safe during market drops. Here are the rules wealthy beginners follow. Rule 1. Never invest money you urgently need. Use money you won't touch for years. Rule 2. Keep a cash buffer. Cash reduces panic. Rule 3. Invest through automatic monthly deposits. This makes dips benefit you through dollar-cost averaging. Rule 4. Avoid checking your investments too often. Checking creates fear and impulse. Rule 5. Stick to your portfolio plan. Your plan protects your emotions. Risk doesn't destroy wealth, emotional reactions do. Why long-term investors always win. Study every major financial crash in history. 1987 Black Monday. 2000 dot-com burst. 2008 financial crisis. 2020 pandemic crash. Every single one recovered. And after each recovery, the market reached new highs. This teaches beginners a powerful truth. If you hold long enough, you don't lose, you grow. The people who lose are the ones who sell at the bottom out of fear. How to choose the right risk level for you. You don't choose your risk tolerance based on courage. You choose it based on your age, your income stability, your emergency savings, your financial goals, your emotional personality. Here's a simple beginner-friendly guide. If you panic easily, use a more conservative portfolio. If you stay calm during volatility, you can hold more stocks. If your income is unstable, keep more cash. If your income is strong and steady, invest more aggressively. There's no right or wrong. There is only what keeps you consistent. Consistency is everything. The risk formula beginner's use. A simple way to manage risk. More time equals more stocks. Less time equals more bonds. If you're investing for 20 plus years, mostly stocks. 10 to 20 years, balanced mix. 5 to 10 years, more conservative. 0 to 5 years, mostly safe assets. This formula protects you from needing money too soon. The biggest beginner mistake: no plan. Most beginners invest randomly. A little crypto. A friend's business idea. A trending stock. Scattered amounts. Money sent to different apps. No system. No long-term goal. This leads to confusion, and confusion leads to emotional decisions. A plan protects you. A plan gives you confidence. A plan removes fear. A plan keeps you invested through storms. Your plan is your shield. Staying emotionally safe. Here is how wealthy beginners protect their mindset. 1. Ignore predictions. Nobody knows where the market will go tomorrow. 2. Focus on long-term trends. Years matter, not days. 3. Expect volatility. You won't panic about things you expect. 4. Automate everything. Automation removes fear. 5. Judge your progress yearly, not weekly. Wealth is measured in decades, not hours. When your emotions stay stable, your investments stay safe. The only time beginners lose money. Beginners lose money when they sell during a crash. Invest out of excitement. Invest what they can't afford. Chase hype. Try to time the market. Follow social media tips. Take advice from unqualified friends. Check their accounts constantly. Investing is simple. It becomes dangerous only when you become reactive. Stay calm. Stay long-term. Stay consistent. This is how beginners win. You now understand how to protect your wealth. Risk isn't something to fear, it's something to manage. You now know the real meaning of risk. How to stay safe. How to manage emotions. How to design a risk level that fits you. How to prevent losses. How the wealthy think during market dips. Part 7. How to build an unbreakable long-term investing mindset. Wealth is not built by those who know the most. It is built by those who stay in the game the longest. The real secret of investing is mindset. How you think, react, and decide when money is on the line. Beginners lose money not because the market is cruel, but because emotions take over at the worst possible time. A system that works means nothing if your mindset collapses when the market dips. This part builds the mental framework the wealthy use to stay calm, hold strong positions, and let compounding do its work. Develop this mindset, and every strategy in this audiobook becomes 10 times more effective. Bullseye. The wealth mindset starts with one rule: stay invested. Most people fail not because they pick the wrong investments but because they buy too late, sell too early, react emotionally, panic during volatility, try to time the market. The wealthy understand the truth. Time in the market beats timing the market. History proves it. Missing even the 10 best market days in a decade can slash your overall returns dramatically. And those best days always come right after the worst ones. That's why wealthy investors don't flinch. They've trained their minds to stay invested regardless of temporary chaos. Chart with downward trend. Why market drops become buying opportunities. Beginners panic when prices fall. Meanwhile, wealthy investors get ready to buy. Why? Because they understand. Drops are normal. Volatility is expected. Prices fall before rising. Corrections are built into long-term growth. Every crash in history, recession, bubble burst, pandemic, inflation, has eventually been followed by recovery and new all-time highs. The beginner mindset sees danger. The investor mindset sees discounts. You don't need to be brave. Just follow the system. Stay calm, keep buying, hold long-term. This alone puts you ahead of most adults. High voltage sign. The 5-second reset. Your anti-panic system. When the market moves wildly, emotions spike. Your brain wants to do something. But reacting emotionally destroys wealth. Whenever you feel panic, use this 5-second mental reset. Pause. Remember your long-term horizon. Say, this move doesn't affect my long-term system. Review your plan instead of your emotions. Continue buying on schedule. This short process keeps you aligned with the system that actually works. You don't need more intelligence, just less impulse. Moneybag master delayed gratification, the wealth superpower. Your ability to delay gratification determines your wealth level. Every dollar invested today becomes more tomorrow, much more next year, life-changing 10 years from now, but only if you let it grow. Beginner mindset. I want results now. Investor mindset. I want freedom later. You build wealth by giving your investments the time they need to multiply. Not rushing. Not comparing. Not chasing overnight gains. Growth takes time. Fortunes take patience. Freedom takes discipline. The no comparison rule. Comparison kills focus. Other people's gains do not affect yours. Other people's strategies do not improve yours. Other people's timelines do not match yours. The wealthy follow this rule. Never compare your journey to someone else's highlight reel. Social media can convince beginners that everyone is making faster money. Everyone has better picks. Everyone knows something they don't. None of this is true. Stay in your lane. Follow your plan. Stick to your system. Consistency beats comparison every time. Bar chart: think in decades, not days. When you shift from a daily mindset to a decade mindset, investing becomes easier. Daily mindset. You panic. You check charts constantly. You react to news. You overthink everything. Decade mindset. You stay calm. You let compounding work. You ignore noise. You build real wealth. The wealthy don't ask, what will happen next week? What stock will explode tomorrow? They ask, what will this investment be worth in 10 years? Does this asset have long-term value? Begin with the end in mind, and the process becomes predictable. Remove emotion from decisions, the CEO rule. Think like a CEO, not a gambler. CEOs don't panic. They don't chase hype. They don't make emotional decisions. They operate based on a strategy, not impulses. Use these 3 CEO-style mental rules. 1. Facts over feelings. Don't let fear or excitement guide you. Check the data. Stick to the plan. 2. Systems over predictions. Protect your progress by following a structure. Automatic monthly investing. Diversified portfolio. Long-term holding strategy. You don't need predictions when you have a system. 3. Process over results. You can't control market outcomes. You can control your habits. Consistent contributions. No panic selling. Not trying to time the market. Staying diversified. Results come from mastering the process. Briefcase: build your identity as an investor. Wealth is built by identity, not willpower. Say to yourself, I am an investor. I invest consistently. I hold long-term. I follow my system. This identity shapes your behavior, especially when emotions are high. When you see yourself as an investor, not a beginner. Volatility becomes normal. Patience becomes automatic. Discipline becomes natural. Confidence grows. Results follow. Your habits change when your identity changes. Rocket the power of boring investing. Here's a truth the wealthy understand. Boring investing is what builds real wealth. Beginners chase excitement. Crypto hype, risky bets, trendy stocks, overnight gains. Wealthy investors follow calm strategies. Index funds, long-term holdings, diversified portfolios, automated contributions. Boring works. Predictable works. Simple works. The more boring your investing strategy is, the more exciting your future becomes. Shield the emotional armor you must build. To succeed long-term, you must protect yourself from common emotional traps. 1. Fear. Market drops, bad news, uncertainty. Solution. Zoom out and remember the long-term trend. 2. Greed. Chasing quick gains, risky bets, hype. Solution. Stick to diversified, proven strategies. 3. Impatience. Wanting fast results. Solution. Automate your investments and stop checking daily movements. 4. FOMO. Seeing others get rich fast. Solution. Stay in your lane and focus on consistency. You don't eliminate emotions. You learn not to act on them. Trophy what a long-term investor looks like. By now, you're building the mindset used by wealthy investors. Here's what that mindset creates. Calm during market dips. Confidence in long-term growth. Consistent investing habits. Patience with results. Trust in the system. Disciplined decision-making. This mindset is the foundation of everything else in this audiobook. Once you master it, the rest becomes far easier and far more profitable. Part 8. How to pick winning investments without guessing or gambling. Most beginners struggle because they don't know what to invest in or how to choose assets that grow consistently. They feel overwhelmed by choices: stocks, ETFs, bonds, crypto, real estate, index funds, mutual funds. Yet the wealthy follow a simple, structured process that makes selection clear, predictable, and low stress. This part teaches you the system the wealthy use to find strong, reliable investments without needing luck, predictions, or complicated analysis. Your goal isn't to pick perfect investments. Your goal is to build a strategy that works automatically. Left-pointing magnifying glass. Step 1. Know what you're investing for. Before choosing an asset, define your purpose. People lose money because they buy investments with no plan. They buy fast, sell fast. They switch strategies constantly. They let emotions guide decisions. Wealthy investors ask one question first. Is this investment aligned with my long-term goal? There are 3 main investment goals. 1. Long-term wealth. 10+ years. Ideal assets: index funds, ETFs, blue-chip stocks, real estate. 2. Medium-term growth. 3 to 10 years. Ideal assets: sector ETFs, dividend stocks, bonds mixed with stocks. 3. Short-term safety. 0 to 3 years. Ideal assets: high-yield savings, money market funds, treasury bills. If your money is needed soon, protect it. If your money is for your future, grow it. Matching the goal to the asset is how wealthy people avoid losses. Chart with upward trend. Step 2. Choose the right types of investments. Beginners often feel overwhelmed, so let's simplify the investment universe into the categories that actually work for long-term wealth. 1. Index funds, best for beginners. These track the whole market automatically. Why they work: instant diversification, historically strong returns, low fees, no need to pick individual companies, compounds powerfully over decades. This is the simplest, safest wealth-building engine. 2. ETFs, exchange-traded funds. ETFs are like modern index funds. You can buy one and instantly own hundreds of companies. Choose total market ETFs, S&P 500 ETFs, international ETFs, dividend ETFs. These grow steadily and protect you from picking wrong companies. 3. Blue-chip stocks. These are large, stable, proven companies. Examples of characteristics: strong track record, billion-dollar market caps, global influence, long history of profits, not fast money, reliable money. 4. Bonds, lower risk, lower return. Ideal for stability or balancing your portfolio. 5. Real estate. For cash flow and long-term appreciation. Real estate is slower but powerful for long-term wealth. Fire. Step 3. Use the 4-point checklist to evaluate any investment. The wealthy don't guess. They evaluate quickly using predictable criteria. Use this checklist for ANY investment. Heavy checkmark 1. Stability. Is the asset proven? Does it survive downturns? Does it have a long track record? Heavy checkmark 2. Growth potential. Is the sector growing? Is demand rising? Does the market expect long-term expansion? Heavy checkmark 3. Low fees. Fees eat your profits. Wealthy investors avoid high-fee funds. Heavy checkmark 4. Simplicity. If you don't understand it, you shouldn't invest in it. When an investment checks all 4 boxes, it's usually a strong long-term choice. Bar chart. Step 4. Build the 3-layer beginner portfolio, the system that works. To grow your money predictably and safely, use a simple layered structure. Layer 1, the foundation, broad market ETFs, 60 to 80%. This is where most of your wealth will come from. Examples of what this includes conceptually: total market funds, S&P 500 funds, global index funds. This layer is your long-term engine. Layer 2, the growth boost, sectors or blue chips, 10 to 30%. You add exposure to strong industries: technology, healthcare, energy, financials. This adds extra growth without taking huge risks. Layer 3, safety and stability, bonds or cash equivalents, 10 to 20%. This protects you during downturns. It's not for growth, it's for peace of mind. The wealthy build portfolios that balance growth and stability. Beginners must do the same. Bullseye Step 5. Never choose investments based on emotion. Remove decision-making from hype, fear, or pressure. Avoid buying because a friend said it's good. Social media is hyping it. Everyone else is buying. You feel FOMO. It had a recent spike. Emotion destroys wealth. Instead, always ask, does this fit my long-term system? If not, skip it. The wealthy skip more investments than they buy. That discipline builds consistency. Bank Step 6. Keep it long-term, the compound effect. The wealthiest investors don't constantly shuffle their investments. They choose quality. Hold for years. Add consistently. Let compound interest multiply their money. Compounding turns decades into millions. Example mindset. You don't buy today expecting results tomorrow. You buy today expecting freedom 10 years from now. If you choose investments using this system, slow growth becomes exponential growth. No entry. What beginners must avoid at all costs. Avoid these common mistakes. 1. Trying to get rich quickly. Leads to losing money quickly. 2. Putting all money into one investment. One mistake wipes out your wealth. 3. Switching investments constantly. Kills compounding. 4. Investing without understanding. If it's confusing, skip it. 5. Listening to hype. The loudest voices usually have the least expertise. 6. Emotional decisions. Fear and greed are the enemies of wealth. Graduation Cap Step 7. Practice the calm investor rule. Before buying anything, say this: I only invest in what I understand and what I can hold long term. This rule filters out bad opportunities, protects your money, builds confidence, keeps your portfolio safe. Wealth grows in the calm decisions, not the dramatic ones. Trophy what this system guarantees. If you follow this approach, you will choose investments confidently, avoid beginner traps, build wealth steadily, sleep peacefully at night, grow money long-term without stress, invest like wealthy individuals, not gamblers. Picking investments becomes simple, not overwhelming, predictable, not confusing, proven, not risky. This is how beginners start winning. Part 9. The ninth key principle in the system that actually works for beginner investors is risk management and portfolio protection. While investing is one of the most powerful tools for building wealth, it is also inherently associated with risk. Beginners often focus solely on potential returns without understanding how to protect their capital and manage exposure to market fluctuations. Without risk management, even a profitable strategy can lead to unnecessary losses or emotional stress, undermining confidence and long-term results. Understanding risk in investing. Risk is not the enemy. It is the natural companion of opportunity. Every investment carries some degree of uncertainty, whether in the stock market, real estate, or other asset classes. The key is to understand, measure, and manage risk rather than avoid it entirely. There are several types of investment risk that beginners must learn to navigate. Market risk. The risk that the overall market will decline, affecting the value of your investments regardless of company performance. Business or asset risk. The specific risk tied to a company, property, or asset. Poor management, economic changes, or sector challenges can impact returns. Liquidity risk. The risk that you cannot sell an asset quickly without significantly impacting its price. Interest rate and inflation risk. Fluctuations in interest rates and inflation can erode the value of certain investments over time. Emotional risk. Perhaps the most overlooked, this risk arises when fear, greed, or impatience drives poor decision-making. Core principles of risk management. Successful investors implement strategies that limit downside while allowing upside potential. Some essential principles include diversification. Don't put all your eggs in one basket. Spread investments across different asset classes, sectors, and geographic regions to reduce exposure to any single risk factor. Asset allocation. Balance investments between stocks, bonds, real estate, and cash according to your risk tolerance, time horizon, and financial goals. Position sizing. Determine the appropriate size for each investment to prevent any single asset from disproportionately impacting your portfolio. Stop loss and protective measures. Set predefined exit points for investments to minimize losses during market declines. Regular portfolio reviews. Assess performance, rebalance allocations, and adjust strategies based on changing markets and goals. Case study. Risk management in action. Consider two investors, Alex and Jordan. Alex invests aggressively in a single technology stock because of its high potential return. When the stock experiences a sudden drop due to market volatility, Alex suffers a significant loss, panics, and sells at the bottom, crystallizing the loss. Jordan, on the other hand, diversifies across sectors, maintains a balanced asset allocation, and has stop-loss thresholds in place. When one stock declines, the overall portfolio remains stable, and Jordan can reinvest strategically, taking advantage of opportunities created by market fluctuations. This example highlights the importance of proactive risk management to preserve capital and protect emotional well-being during volatile periods. Developing a risk-managed portfolio. For beginner investors, building a risk-managed portfolio involves several actionable steps. Assess risk tolerance. Understand your ability to withstand fluctuations in investment value, both financially and emotionally. Define time horizon. Longer investment horizons allow for more aggressive strategies, while shorter horizons require more conservative approaches. Diversify across asset classes. Include a mix of stocks, bonds, real estate, and cash equivalents to reduce concentrated risk. Use dollar-cost averaging. Invest regularly over time to smooth out market volatility and reduce the impact of timing risk. Implement protective strategies. Consider stop-loss orders, hedging, or other mechanisms to minimize downside exposure. Regularly review and rebalance. Periodically adjust portfolio allocations to maintain your desired risk profile as markets evolve. Educate yourself on market dynamics. Understanding macroeconomic trends, sector rotations, and market psychology enhances your ability to anticipate risks. Mindset for managing risk. Risk management is not just a strategy, it's a mindset. Investors with the right mindset approach risk with discipline, patience, and emotional control. Embrace risk as part of growth. Understand that risk is a natural component of investing, and avoiding it entirely limits long-term returns. Detach emotion from decision-making. Avoid impulsive actions driven by fear or greed. Stick to your plan and review decisions logically. Prioritize capital preservation. Protecting what you already have is as important as seeking gains. Wealth compounds most effectively when losses are controlled. Think in probabilities. Approach every investment with a realistic understanding of potential outcomes rather than assuming guaranteed success. Continuous learning. Stay informed about financial markets, economic indicators, and investment strategies to anticipate and mitigate risk proactively. Key takeaways. Risk is an inherent part of investing, but it can be managed with the right strategies. Diversification, asset allocation, position sizing, and protective measures are essential for reducing exposure. Regular portfolio reviews and adjustment ensure your strategy evolves with changing conditions. Developing a risk-aware mindset protects both your capital and your emotional resilience. Effective risk management allows beginners to invest confidently, focus on long-term growth, and navigate market volatility successfully. By mastering risk management, beginner investors transform uncertainty into opportunity, laying a foundation for consistent, sustainable growth in any market environment. This principle ensures that your investing journey remains disciplined, strategic, and resilient. Part 10. The 10th principle in the system that actually works for beginner investors is consistent monitoring, review, and adjustment of your portfolio. Investing is not a set-it-and-forget-it activity. Even the most carefully planned portfolios need regular oversight, rebalancing, and refinement to stay aligned with financial goals, market conditions, and personal circumstances. Beginners who neglect this principle often face stagnation, missed opportunities, or unnecessary risk exposure. Why regular monitoring matters. Markets are dynamic. Interest rates change, economic cycles shift, companies evolve, and global events impact asset values. Without consistent monitoring, portfolio drift occurs. As certain assets grow faster than others, your portfolio allocation may deviate from your desired risk profile. Opportunities are missed. Market dips, sector rotations, and emerging investments can create high potential entry points if you are actively monitoring your holdings. Risk exposure increases. Unreviewed investments may carry higher risk than intended due to changes in market conditions or company fundamentals. Goals may become misaligned. Life changes such as career growth, family needs, or retirement planning can shift financial objectives, requiring portfolio adjustments. Establishing a review routine. Beginner investors benefit from structured review processes. A recommended framework includes monthly quick checks. Monitor portfolio performance, cash flow, and any unusual activity or news affecting your investments. Quarterly deep reviews. Assess asset allocation, sector exposure, and performance against benchmarks. Adjust allocations as necessary. Annual strategic reviews. Align your portfolio with long-term goals, risk tolerance, and life circumstances. Consider tax implications, retirement planning, and succession strategies. Event-driven reviews. Significant market events, personal milestones, or changes in economic policy may require unscheduled assessments to ensure protection and opportunity. Key tools for monitoring and adjustment. Portfolio tracking software. Use tools that consolidate investment data, track performance, and generate visual insights to make informed decisions. Financial advisors and mentors. Expert guidance can provide perspective, alert you to opportunities, and help refine strategies. Market research and news. Stay informed on global economic trends, company news, and regulatory updates that could impact your investments. Analytical metrics. Monitor key indicators like return on investment, ROI, volatility, beta, and diversification ratios to assess portfolio health. Checklists and reports. Maintain systematic checklists to ensure all pillars of your investing strategy are evaluated during reviews. Portfolio rebalancing. Rebalancing is the process of adjusting your portfolio to restore your intended allocation. For beginners, this ensures that risk remains consistent and growth targets are realistic. Example: suppose your target allocation is 60% stocks and 40% bonds. If stocks surge to 70% of your portfolio, your risk exposure has increased. Selling a portion of stocks and reinvesting in bonds restores balance. Frequency. Many investors rebalance quarterly or annually, but adjustments can also be event-driven when deviations exceed a predefined threshold. Case study. Active review in practice. Consider two investors, Mia and Kevin. Mia invests in a diversified portfolio but never reviews her holdings. Over time, technology stocks outperform, shifting her portfolio to a 75% allocation in tech. When a market downturn hits, her losses are magnified due to concentrated risk. Kevin, in contrast, reviews his portfolio quarterly. He notices the tech sector overweight and rebalances to maintain his target allocation. Additionally, he identifies undervalued assets in other sectors during his review and strategically invests, capitalizing on opportunities while controlling risk. Kevin's disciplined approach demonstrates that consistent monitoring and adjustment amplify gains while minimizing exposure to unnecessary risk. Practical steps for beginners. Set a review schedule. Decide on monthly, quarterly, and annual reviews to maintain structure and discipline. Assess asset performance. Compare each investment against benchmarks, expected returns, and risk tolerance. Rebalance strategically. Adjust allocations to maintain intended risk levels and capitalize on market opportunities. Document decisions. Keep a record of why adjustments were made, providing clarity and preventing emotional reactions. Incorporate goal tracking. Ensure portfolio adjustments reflect changes in personal and financial objectives. Learn from data. Analyze historical performance to identify trends, strengths, and weaknesses in your investment strategy. Mindset for portfolio monitoring. Discipline over emotion. Focus on logic and strategy rather than reacting to short-term market fluctuations. Patience and consistency. Long-term success comes from steady, deliberate adjustments rather than frequent impulsive trades. Continuous learning. Use monitoring as an opportunity to improve understanding of markets, sectors, and investment strategies. Proactive, not reactive. Anticipate changes and adapt before issues become problems, rather than waiting for crises to act. Key takeaways. Regular portfolio monitoring, review, and adjustment are essential to long-term investing success. Consistent evaluation helps maintain allocation, manage risk, and align with evolving goals. Rebalancing prevents overexposure and ensures risk remains consistent with your strategy. Structured monitoring empowers beginner investors to make informed, confident decisions. A disciplined review process maximizes growth potential while protecting capital and emotional well-being. By mastering this principle, beginner investors take control of their financial journey, transforming passive holdings into a strategic, adaptable, and resilient portfolio designed to grow wealth reliably over time. Part 11. The 11th and final principle in investing for beginners. The system that actually works is patience, discipline, and long-term focus. While strategies, risk management, and portfolio monitoring are essential, beginners often underestimate the power of time and consistency. True wealth is rarely built overnight. It is the result of persistent, disciplined action sustained over years and decades. Why patience is a superpower. Investing is fundamentally a long-term game. Market fluctuations, economic cycles, and global events create short-term volatility that can tempt investors to act impulsively. Beginners who chase quick gains, panic during downturns, or abandon their strategy often erode capital and confidence, undermining years of progress. Patience allows investors to ride out market volatility. Avoiding reactive decisions during downturns protects portfolio value and leverages the power of compounding. Benefit from compound growth. Investments grow exponentially over time when gains are reinvested and left to accumulate. Even small contributions grow substantially over decades. Learn from experience. Staying invested provides first-hand insights into market dynamics, improving decision-making and confidence. Maintain emotional stability. A patient mindset prevents impulsive actions driven by fear, greed, or short-term market noise. Discipline, the engine behind consistency. Discipline is the ability to follow a strategy consistently, regardless of emotions or external pressures. It is what separates successful investors from those who flounder. Key components include regular contributions. Commit to investing consistently, whether monthly, quarterly, or annually. Dollar-cost averaging reduces timing risk and builds wealth steadily. Adherence to strategy. Stick to your predetermined asset allocation, risk profile, and investment plan, adjusting only when data and strategy dictate. Avoiding speculative temptations. Focus on proven, methodical strategies instead of chasing high-risk, hype-driven opportunities. Reinvestment of gains. Use dividends, interest, and capital gains to grow your portfolio instead of withdrawing prematurely. The long-term focus. Long-term focus requires thinking in decades rather than days, months, or even years. Beginners who embrace a long-term perspective recognize that short-term losses are temporary. Market dips are inevitable, but patience ensures these fluctuations do not derail overall growth. Consistency outperforms timing. Regular, disciplined investing consistently outperforms attempts to time the market or predict trends. Wealth accumulates exponentially. The combination of consistent contributions, compounding, and strategic growth multiplies wealth far beyond what short-term gains can achieve. Financial security requires time. Building a robust, resilient portfolio capable of funding retirement, education, or legacy goals cannot be rushed. Case study: the power of patience. Consider two beginner investors, Liam and Sophia. Liam is eager to grow his wealth quickly. He frequently buys and sells based on market news, trends, and hype. Over time, transaction costs, poor timing, and emotional decisions reduce his overall returns, leaving him frustrated and unsure. Sophia invests using a disciplined, long-term approach. She follows a plan, regularly contributes to diversified assets, reinvests gains, and reviews her portfolio periodically. Despite short-term market volatility, Sophia's wealth grows steadily, compounding year over year. Sophia's results illustrate that patience and discipline are more valuable than chasing immediate profits, and consistent, focused action is the hallmark of successful investing. Practical steps to develop patience and discipline. Set clear long-term goals. Define your target wealth, retirement plans, and financial milestones to maintain focus. Create a strategic investment plan. Include allocation, diversification, contribution schedules, and risk management strategies. Automate contributions. Automating regular investments prevents procrastination and ensures consistency. Focus on the big picture. Avoid reacting to daily market news or short-term price swings. Evaluate performance over months and years. Reinvest and compound. Use dividends, interest, and gains to increase portfolio value rather than spending them prematurely. Maintain an investment journal. Track decisions, lessons learned, and emotional responses to build self-awareness and improve discipline. Celebrate progress, not instant success. Recognize long-term growth and milestones rather than short-term fluctuations or market noise. Mindset for long-term investing. Trust the system. Believe in the methodical strategies you have learned and implemented. Control your emotions. Detach decisions from fear, greed, and impatience. Act according to plan. Focus on growth, not perfection. Small, consistent steps yield significant results over time. Perfection is not required. Embrace the journey. See investing as a lifelong practice, learning from successes, setbacks, and market lessons. Commit to continuous improvement. Regularly educate yourself, refine strategies, and adapt without abandoning core principles. Key takeaways. Patience and discipline are essential to transforming investing from a gamble into a reliable wealth-building system. Long-term focus ensures that short-term market fluctuations do not derail financial goals. Consistent contributions, reinvestment, and adherence to strategy maximize the benefits of compounding. Emotional control prevents impulsive decisions and preserves portfolio growth. Beginners who commit to this principle develop the mindset and habits of successful, seasoned investors. By mastering patience, discipline, and long-term focus, beginner investors complete the system that actually works, creating a robust foundation for sustainable wealth, financial freedom, and lifelong security.